All right, welcome back. My name is Nigel Schroeter, also known as the Credit Sensei, also known as the Young King. And today we're going to be bringing you guys a strategy that's going to allow you to build credit with bad credit, no credit, and potentially under the age of 18. If that interests you, please stay tuned for the rest of the video. So today I'm so happy to bring this strategy out to you guys. I've talked about this strategy before, but it was always very briefly, and I kind of brushed over it, and I thought about it, and I was like, I should more blatantly put this out there, because this is what actually allowed me to accidentally sneak into the credit world and never have to get a secured card, secured loan, or anything like that. Except for when I did them by choice. My first credit card was on my 18th birthday and it was unsecured. And a lot of you are probably wondering, how did you already have enough credit established on your 18th birthday to get an unsecured card? I will tell you this. I originally did not even know myself until I found out that I made a smart decision by accident that could have gone really badly. However, with the world that we live in, money is available to you, and it's available to you in so many ways that you've probably never thought about, or it's so blatantly in your face that you don't think to use that money. So what am I talking about? Let me kind of lay this out. So I went to college when I was 17. When I went to college, I actually was given a full scholarship. So between my Pell Grant and the scholarship that the college gave me, I didn't have to pay for anything. However, me being me, my mom's blatantly told me, do not take out student loans if your college is paid for. Nigel being Nigel said, I'm going to take one. So what I did do, however, was I took only subsidized student loans. And I took subsidized student loans because they told me that there was no interest on them while you were in school. There was low origination fees. And as long as you paid them back before you graduated, there'd be no interest. So, just like the bright child that I am, I took out the subsidized student loan. And what did it do? It started reporting a positive loan payment to my credit report every month, because while you're in school, it has a status of in school. So it just gives you positive payments the whole time that you're in school for your student loans. So this was great for me because I went to college 6 months before I turned 18. So to the bank, all they see is that I have a student loan. It's been paid on time for the past 6 months. And because what I actually did was, when I got the student loan money, I took half of it and I paid it back on the student loan immediately. It showed the balance paid down. So it really looked like I was actually paying on this loan. All right. So by using this technique, I was able to get about, I want to say $2,500, no interest. And I was able to keep that money as long as I was in school without paying interest. And once I graduated or left the school, then I'd be paying back at a 6% interest rate, which, as many of you may know, for a college student, or for anyone, really, if you don't have perfect credit, or if you have no credit, 6% interest rate is really great. For trying to get a return on investment, if you're investing in stocks or anything like that. Remember, you got 0% to start out with, and then 6% once you leave school or graduate. Plus, the payments are deferred the first 6 months after you graduate. And for people in my particular case, we have it even better because our loan payments are deferred further out due to the pandemic. If you still have any student loans. So basically, I was able to acquire these loans, and had I used them smart and doing what I'm telling you guys to do, you could have gotten one of these loans. You could use it to get secured products to build your credit faster. You could use it to invest, and you can use it to start a business. You could also use it to purchase a car, because for most college students, that's how they get hit, is because they go to purchase a car from, buy here, pay here for a used car dealership or whatever, and they charge them like 20% interest or higher. So by being able to get this loan with 0% interest, or, really cheap interest, 6%, that's way better than 20%. And even if you want to buy a newer car, you could get one of these loans, wait until, your second or third semester in school, and then your credit score should be high enough where you could go to a dealership and get a cheaper interest rate. So this is a very lucrative strategy if used appropriately. It can go bad, particularly for myself, and I know most people. When you go to grad school and you take out loans, those loans are heftier and they're harder to pay back instantly. And because I didn't really search for scholarships or anything like that, those grad school loans are kind of hefty. I happen to be paying them back through another business that I started. So I'm basically taking those funds and revolving them back into paying off my grad school loans. However, you don't really want to be in a situation where you have to create another stream of income just to pay back, something after the fact. It's better to be able to create that stream of income and it be paying it as you go. You never want to be chasing bills. You rather be proactive and working ahead of your bills. So that's why I'm telling you, if you're undergrad, go ahead, create that business, do those investments, build up those funds, so that way, by the time you do graduate, instead of you trying to put funds together to pay back the school, you're putting funds together and you've paid back the school. You've made $100,000 off of the money that they've lent to you, and you're buying a house cash. So with that being said, you guys, thank you all for watching. Thank you all for tuning in, and I'll see you guys in the next video.